Welcome to the What to Watch video update. This is a video that I do every week, but what I look at during the week can change. This is as of the weekend after Friday, October 11th. What are the things that I'm really focused on right now? And we asked the question because the S&P set a new all-time high on Friday. Will the S&P set more all-time highs in the upcoming week and month as we play out the rest of 2024? Before I get started, I do have a thing called the SPX investing program. It's up, it's going, it's free until the end of 2024. Feel free to check that out. You can email me if you have any questions or comments about it. You can also get to the website by clicking a link below this video, and you can also click to a video that explains more about the program. Also, the What to Watch video that you're watching right now is just one of many videos that I do over the weekend. The real focus is the daily video. All the videos that I do tie into the daily video. Okay, so first of all, I come up with a list of those things that are looking positive as of right now. Now, with a lot of these charts, it depends on how you look at it. It can be taken as positive, but then there might be some negative things that we can pull out from that chart. When we get to the negative side, yes, things might look negative, but there might be some positives that we can take away from that as well. So it's not quite as cut and dry here. The first thing to look at is the condition of our trend. We are seeing a bit of an improvement as the S&P set a new all-time high on Friday. We're above the moving average and the green line's on top, and we're above 20. So taken all together, we are in a positive strengthening trend right now in the intermediate term, which is usually weeks to months. We're also looking pretty good when we look at the advanced decline line based on price, almost back to this previous high, but breaking out and looking a little bit better based on volume, which can be positive when volume leads price higher. We're also looking pretty good with a lot more new highs than we're seeing on new lows. Hasn't done too much to turn our 5-day moving average back up. That's mainly because of the contraction we were seeing as we were going more or less sideways for a number of days. We're trying to turn back up after leveling off here with our 10-day moving average. So internally, this is looking positive. We're above zero and going up with the 19 and 39 period advanced decline ratio. That's positive. And we're looking positive here with accumulation distribution. The one negative thing is you notice that I have a moving average over the volume here, and we've been below average with volume for many, many days. That is a bit of a concern as we're going up with the S&P and we're dropping down as far as volume is concerned. That's kind of a technical analysis basic idea that when we're going up, you want to see an increase in volume, and when we're going down, that's when you want to see a decrease in volume. We're just seeing the opposite of that. We're going up on a decrease in volume where you usually want to see the increase. And also we're possibly getting kind of far away from the moving average here when we look at accumulation distribution as measured by the boom indicator. It's getting a little extreme right now. The chicken money flow, it's still positive, but we're a little bit concerned. We set an all-time high. We've been going up, and this is actually starting to go down, and the red line's going down. So it's still positive when you look at green versus red, but we don't like how this is actually turning a little bit more negative right now. The Chaikin oscillator, which had been chopping sideways for a number of days, is now starting to show an improvement, so that's looking positive. The vortex, again, setting an all-time high on Friday, but we went down with the green line. On the positive side, we also went down with the red line. But this is still positive because the green line is above the red line. Bullish percent index coming off of a very, very high reading, which could be negative. You see other times when we really spiked out, and that ended up being some kind of a top in the market. Not always. Sometimes we would get a high reading and then just go sideways for a while. We're wondering if it's going to play out that way this time, or if this is actually showing us some kind of a reversal could be happening. But when we look at the NYSE bullish percent index, and this is a broad market measure, yeah, it's coming down a little bit, but still looking really solid. And the NASDAQ 100 bullish percent index is above 50 and going up, not breaking out, not showing an awful lot of strength, but it is positive. The condition of the 20 period moving average. And that's really what I'm focused on right now because we're above the 20 period moving average. We're above both the green line and the blue line here. So that's looking pretty solid by this measure. Also, when we look at a simple and exponential moving average, we're above both lines. That's positive. And we look at a short-term rainbow going from 10 periods up to 50 periods, we're above all the lines and all the lines are going up. So the short-term trend is clearly positive. And here are all the plotted moving averages. Price is above all of them and all of the lines are going up. Then how many of the stocks on a percentage basis inside of the S&P are above their 20 period moving averages? Not really breaking out, showing an awful lot of strength, but we are above 50. And after briefly dropping below 50, we have been bouncing back up. We look at an intraday chart of growth versus value, and we were seeing an improvement here where the blue line was getting above the red line. That means the growth was outperforming value intraday. Well, in Friday's session, growth wasn't up all that much, and value was really what was strong. And both these lines have come back up together, but they're both positive for the most part. But we would like to see the blue line outperforming the red line to be more positive on the S&P. Looking at a growth to value ratio for the S&P itself, since the beginning of October, we have been going up overall. We did come down a little bit on Friday, and that's a little bit of a concern. Is this just like a little pit stop before we continue to go up, or is this the beginning of showing some weakness coming into the S&P? On an end of day chart, we are looking pretty good here. We broke out above this previous high here with the growth to value ratio for the S&P, even though it did turn down a bit on Friday. And the discretionary to staples ratio, looking really solid here. That's positive when you look at it all by itself. But when you look at the context, it's not that discretionary is doing all that well. It's not breaking out to new highs here. It's that we've been seeing weakness in the staples. And that's what's making this ratio really go up. But we want discretionary to do better, even though Tesla got just hammered in Friday's session. And that brought the discretionary sector under some pressure. But we want to see this going up and the staples going down, and then see the ratio going up as well to be even more positive. Large cap growth above all the moving averages, not setting quite an all-time high yet. You might make a case for that, but still looking quite positive there. And the risk on to risk off ratio, for the most part, is continuing to go up. That means folks are more risk on. They're favoring stocks over the more conservative stocks throughout that they can get into when the market's more defensive. Swenlin trading oscillator coming back above zero based on price, above zero based on volume. But you notice how we went up with price and we were flat based on volume. A little bit of a concern there, but for the most part, this chart is positive. After being negative for 5 days, we've now switched back to positive with the parabolic SAR. I don't have the chart here, but we're also positive with the weekly parabolic SAR chart. The Staples to S&P 500 ratio, when this is going down, that's more positive for the S&P, and that's for the most part what it's been doing. We look at the S&P 500 cumulative advanced decline line based on price, not coming out and setting a new high yet, but see how we're setting a new high based on volume? That could be positive with volume leading price higher. We look at the NYSE cumulative advanced decline line, setting a new high here, not setting a high with the NYSE advanced decline line, but still looking pretty solid and positive. The common stock NYSE advanced decline line, not setting a new high yet based on price, but we are setting a new high based on volume. So we're seeing volume looking more healthy than price right now in the S&P and in the NYSE when we just look at common stock. The advanced decline line, all of them are looking pretty healthy right now. NYSE common stock is going up, but not setting a high yet. Just about setting a high with the S&P, showing an improvement with the mid caps, and after coming down to the moving average, bouncing up with the small caps. And now this is another way of possibly looking at Dow theory. Traditional Dow theory uses the Dow and the transports. Well, that was created a long time ago by Charles Dow. Another way of looking at this could be, well, instead of using the Dow, why don't we use the S&P? And instead of using the S&P, let's use the S&P equal weight. All right, okay. This is setting an all-time high. Well, instead of using the transports, why don't we use the NASDAQ? And then why don't we break it down even more and use the QQQs and break it down even more and use an equal weight version of the QQQs? Now, this is positive because we're setting an all-time high based on the S&P equal weight. This is a negative divergence because we have not set a new high here with the QQQ equal weight ETF, at least yet. But we're getting closer. We're showing some improvement here. We want to keep an eye on this. So there's some positive things and some negative things to take away from this chart. The Wilshire, another broad market measure, setting an all-time high on Friday. That's positive. Total U.S. stocks here, the ETF, the biggest ETF that I know about, setting an all-time high. That's positive. The Dow set an all-time high on Friday. NASDAQ not setting an all-time high, but still looking positive. Same thing with the NASDAQ 100. Still a ways to go to its all-time high and lagging since it hit its high back in July, but still looking pretty positive. The momentum for the NASDAQ 100, after coming back down to the moving average and threatening to turn negative, is now looking more positive. The mid caps breaking out of this range. It'd be nice if they could keep going from here. They've been really chopping sideways lately. The bank ETF, we had the banks come out with their earnings, at least a major portion of the big banks, and they were very well accepted. And so that's really helping this ETF to go up. It's also helping the financial sector to go up and set a new all-time high. The FANG index, not back to the all-time high set in July yet, but still looking positive. And we're still below this shorter term trend line, but above this longer term trend line. It would be more positive if we could break above this shorter term trend line. When this is going down, this means that bonds are underperforming stocks. And so that's positive for stocks. Here's an inverse of that same thing, showing how stocks are outperforming bonds, setting a new high here. And the market is really anticipating that we will have a soft landing, meaning that we're not going to go into a recession. We look at a broad market measure, the S&P 1500, and compare it with short-term bonds, breaking out to a new high with this ratio. So broad market, when you look at it that way, is looking quite positive compared to short-term bonds. Then we look at another broad market measure and go further out with bonds, also setting an all-time high with this ratio. The tech sector is improving, but not back to the all-time high yet when we look at that compared to 3 to 7 year bonds. The QQQs, the 3 to 7 year bonds, also improving, coming up out of the rainbow, but not back to the all-time high yet. Home construction coming down a little bit, but still looking pretty solid when we compare it to 3 to 7 year bonds. And interest rates have been going back up, and that's one of the more negative things that we're watching. But the stock market hasn't really noticed that yet, or it's not really bothering the stock market, at least yet. Long term, going back to 2009, we're looking really solid with this chart of a trend channel. Here's a weekly chart, and we're well above this R2 pivot point as we're setting an all-time high with the S&P. And we look at a ratio between the NASDAQ 100 and the Dow. We're still getting a very high reading up here, and that's positive. A weekly chart of the NASDAQ 100 going back to 2009, still looking quite positive here. A ratio between semiconductors and the Dow, it could be a bit better with this. We want to go back up. That would be more positive for the market, but we are showing some improvement here. Now we look at some negative things. Now, right now, when we look at sentiment, we're positive. We're very positive, maybe too positive. We're at 74 right now. When we get above the 75 level, that's when we start to get concerned. Now, we can stay up around this level for extended periods of time, like we did in early 2024. But a lot of times when the market gets a little too exuberant here, that's when it's due for at least some kind of a pullback. And we're seeing other things that are giving us warning signs, but the market's pretty much ignoring them right now. If we continue to go up as far as sentiment, maybe that will be something that we need to pay attention to. This is one thing that's negative. We're setting an all-time high with the S&P and the VIX is above 20. Very strange. We usually get a very low reading when the S&P is really going up with a lot of conviction. And the VIX of the VIX also giving us a very high reading where normally this would be low when we're setting all-time highs with the S&P. And then Tom Bowley did this research. He's connected with earningsbeats.com and stockcharts.com. And when we're above 20, where we're at now, we closed at 20.46. we're now up into this red area, and that's where we see negative annualized returns. The lower the VIX goes, the higher the annualized returns become. So the market isn't really paying attention to this right now, but at some point it might if we still stay above 20 with the VIX. And the momentum of the VIX continues to be up. And this is another study showing a correlation between the VIX and S&P. I've been watching this for about a week, and this is above the dashed line, meaning the market is getting nervous, but it's been up here now for a number of days, but the S&P keeps going up. The skew index also for the last week, I've been watching this. It's still in this red area, even though it's coming down. The market is expecting some kind of a big move, and because of the VIX and because of the momentum of the VIX, and because of the other studies with the correlation that we're seeing, you would think that maybe the big move that's expected is to the downside. But we keep going up, but we're still in this red area. If we really start to come down with the S&P, is this going to drop out of this extreme reading? Then we look at an equity put call ratio based on 5 days. We're starting to drop below this red line where a lot of times you look at other times when eventually we bottomed and started to go back up, you can see what the market often did after that. Sometimes we went sideways, sometimes it marked a top, other times it really didn't have much of an impact. So we just want to keep an eye on this one. This is a longer term look at that same chart, just to give you more perspective here. So we could still go much lower than where we're at right now. Volume is a concern. We're below average with volume, and this is a volume oscillator that continues just to go down, down, down. And that is a concern as we've been hitting all-time highs with the S&P. The McClellan oscillator is showing an improvement here, but still just barely negative. And when the McClellan oscillator is negative for the S&P, that means that we're going down based on price, even though it's slowing down here. Now, a positive thing is we're starting to turn back up based on volume. So we're seeing a bit of a divergence here. It could be positive, where we're slowing down with the decline with price and starting to go up based on volume. That could be a positive thing. But until we see that actually play out, we have to treat it more as negative. And we're showing an improvement here with the NYSE McClellan oscillator, another broad market measure, but we're still below zero. So we're declining based on price and volume with the summation index. And we're seeing a real mix here with our momentum oscillators. Looking a little better with the slope, but still below the moving average. Turning back up with our other short-term TSI oscillator, but looking better with the intermediate term, with the MACD, the PMO, and PPO, on top of the moving average with our long-term oscillator, the TRIX, but still declining with the KST. So we're not seeing across-the-board confirmation here. And when we compare small caps to the S&P, small caps are continuing to underperform. Small cap growth to value, end of day chart here, showing an improvement, but still in a downtrend. Mid cap growth to value, improving, but still in a downtrend. And we're going back up with the 10-year yield. We climbed back up over 4%, and it's like the market, stock market anyway, didn't even care. And we're seeing a real move up here as folks are getting more into the riskier bonds like junk bonds instead of the more conservative bonds as interest rates have been going back up. And we're wondering about the context here, because when we looked at this chart for the last couple of years, when we measure cash to 3 to 7 year bonds, when this is going up, that means there's uncertainty about interest rates. Okay, well, interest rates are going back up, but not by the Fed. They're cutting rates. And there's often inflation worries here. Well, we just had CPI and PPI come out, and the market deemed those as market friendly, and that we're possibly going to have a soft landing. So why are we going up here? Are we starting to change the context of seeing a higher interest rate environment where stocks can still go up at the same time? We don't really know the answer to that yet. We can just speculate and then just watch this as it's played out, because usually when this is going up, that means the market is starting to get concerned. You don't set all-time highs when the market is concerned. Then we see that same kind of thing here with TIPS, Treasury Inflation Protected Securities, with a ratio of 3 to 7 year bonds. We're going back up, even though we're in a downtrend here. Back in late 2021, when this was really going up, that's when inflation was a concern. That's when interest rates were going up by the Fed. Then we saw that really decline, then going up again over the late spring and into the summer. actually just late spring here. But that's because there was some concerns that the economy may be showing some weakness. And we came back down. Now we're going back up again, but we're trying to pick up the context of why this is actually happening. See the same thing here. Tips the further out bonds, 7 to 10 years, had been declining, still in a downtrend, but really starting to go back up as interest rates are going back up. We want to keep an eye on the growth to value ratios. Doing okay here with the Qs to S&P. Discretionary to S&P. This was really doing well, but then Tesla got hammered on Friday and really drove this down. We want this to go up. We're coming down, but we're still above the moving average when we look at large cap growth versus large cap value. And so we look at the large caps still slightly above the moving average, mid cap showing an improvement here, and as are the small caps. But will we see some follow through with this? And then for the most part, we've been declining with the S&P to utilities ratio, and that's negative. We want this ratio to be going up to be more positive for the S&P. And this is just to keep an eye on things. We saw a big spike up in weekly jobless claims, enough to turn the 4-week moving average back up. We're also seeing an increase in continuing claims, and that's turning the moving average back up too. We want to keep an eye on oil, mainly for geopolitical reasons. We got down to about 65, then we really started to spike back up. We're still in the mid 70s right now, and this has a lot to do with what's going on in the Middle East with Israel and Iran and Hezbollah and Hamas and all of that stuff. And then the dollar's in a downtrend, but really been doing well lately here. And usually a stronger dollar is weaker for stocks. Stocks haven't cared as the dollar's been going back up. And then we have this crazy thing called the Hindenburg-Omen, which is on the books, and we have it confirmed. We have two spikes here, and we don't know when this will play out or even if it will play out. But when we had multiple spikes, this was right before the COVID crash, and we also saw multiple spikes, and this can take some time to play out here, right at the end of 2021 when we went into the very difficult year in 2022. So thank you. I hope you found this helpful. If you want updates on what's going on with these charts, please watch the daily videos as I roll them out in the upcoming week. So have a great weekend, and I will talk to you in the next video.